Great. All right, so we will get started in here, and I'm going to keep an eye on the time here. I think we're going into the more fun, the tranquil topic is next. That's medical marijuana, I believe. So we'll get to that, I think, right at the top of the hour at 10 o'clock. So our non-legally binding disclaimer as we started really is what I just said. Healthcare reform for the last 5 years has been predominantly the house without furniture. It continues to change. It includes multiple different professional domains, legal, insurance, tax. It's a very complex law, and it's continuing to evolve on a regular basis. So while we'll arm you and equip you with the most relevant, accurate, up-to-date information today, just understand that this law continues to evolve. So things will continue to change, and we'll continue to keep you informed as they do. So let's talk about employer compliance under the Affordable Care Act. People have heard it called a variety of things: the ACA, the Affordable Care Act, PPACA, PPACA. The most common one I hear, probably Sara too, is WTF. It's probably the most popular one.
You're going to say Obamacare, but WTF.
Obamacare too. That can be a little bit political, and rightfully so. This topic can take on a political tone very quickly. And we've had to work hard, in our respective domains to make sure that we kind of check our politics at the door and just communicate the facts. So we're going to do our best to do that today. So just a little bit of background here. I mentioned, this law is now a toddler, if you will, or beyond that. It's approaching. It's going to kindergarten. Yeah, it's 5 years old, and it's a huge expansion of the United States healthcare system by the federal government. Biggest since the mid-'60s with Medicare and Medicaid. So it's taken all of 5 years to implement, and in some cases longer. So we're seeing that kind of unfold before our eyes here. And there's a couple primary goals here. One is to try to drive down the cost of health insurance while increasing the rate of Americans that have it. I mean, that's really two of the primary goals here, is to make this more affordable while giving it access to more people. And then in theory, by doing both of those things, we should be able to drive down the cost of healthcare in the system, which we all know our insurance premiums are most likely a direct reflection of the cost of healthcare. And that trend line has looked like a hockey stick for some time. So something's got to be done here. It's going to be a lot more time than what we've even given it over the last 5 years to see if this legislation actually produces these results. But I think some of you who are smirking at me as I'm saying this are a little bit cynical maybe in terms of whether these goals are actually achievable with this law. And I think time will tell. So we'll see when we get there. So before getting into some of the compliance considerations moving forward, we just wanted to talk. I mean, there have been a host of considerations and compliance requirements that have kicked in since 2010. So just a quick refresher on just a few of them. We're not going to cover each of these box by box, but lifetime limits on health insurance policies. No longer can you be capped at a lifetime maximum. So all policies, grandfathered, non-grandfathered, what have you, cannot have a lifetime maximum on benefits. Dependent coverage up to age 26. That's affectionately referred to in this industry as the lazy kid law. The state of Illinois was a little bit actually ahead of the federal government in allowing dependents to stay on their parents' plan beyond full-time student status. The federal government came in and kind of adopted a little bit more liberal provision of that section of that law. So any dependent up to age 26 stay on their parents' plan. No questions asked. Doesn't matter if they're married, working, benefits available to them elsewhere. They can stay covered. 90-day waiting period limit. So this was one of the provisions that took effect January 1st of 2014. Can't make a new hire who's a full-time employee wait longer than 90 days for benefits. Some employers had a longer orientation period or a waiting period, so they had to trim that back last year. So if that's something that you and your practice and your business back at home implement a waiting period, just be mindful of that if you haven't addressed that already.
Yeah, I think just to clarify on that, it's not first of the month after 90 days, which that was the eligibility provision that a lot of employers had. It's 90 days. So if you're still using that first of the month after 90 days, that needs to be scaled back. So administratively, first of the month is easier. So a lot of employers have gone to like first of the month after 60, first of the month after 30, but 90 days is 90 days, so.
Yeah, and a lot of carriers address this in their systems when you renewed in 2014 already. So if you're fully insured, I should ask that question too. Is anybody in the room self-insured? Everybody fully insured who offers benefits? So, okay. So the fully insured carrier typically would have addressed that in your contract with them when you renewed in 2014. There have been some new fees, the provider fee, health insurance provider fee, and the reinsurance fee. So all of you being fully insured in this room are paying approximately 3.5% to 3.75% of your premium in the form of two different taxes and fees to the federal government directly as a result of the ACA. So there is a cost-driving component to that we've seen in the short run. One of those is to be phased out over 3 years. But my running joke is the tollway system was implemented before I was born, and I'm just paid 2 tolls on my way out here today. So that was supposed to be a temporary financial program as well. And just a few other things. Again, headline related ACA topics, the establishment of the exchanges. Those of you who follow the news remember how seamlessly these things were launched a year and a half ago. The marketplace opened for business January 1st, 2014 with a few bumps in the road. And they are still open for business. We just completed our second annual open enrollment on the public marketplace. The reason I think this is important for employers to understand is that this next piece, the subsidies for people who shop on the exchange, the subsidy component of the exchange is the trigger for the employer mandate penalty back to you. If you have employees that are eligible for subsidies on the exchange, that would be the potential trigger for you as the employer to receive a penalty back. So I think that's an important piece to understand, and we'll kind of go through how that works in just a second here. So we want to talk about the employer mandate. As we did a quick survey when we get started here, most of you are in that applicable large employer category, meaning you have 50 or more full-time equivalent employees that puts you subject to the employer mandate. So the employer shared responsibility is another term for the employer mandate, and this is an unprecedented component of the law. Never before has an employer been mandated to provide benefits of a certain quality level and at a certain cost level or face a financial consequence. All of you who offer benefits, who offered benefits previous to the ACA being signed into law did so because it was a strategic thing to do in your business. It helped with recruiting and retaining people, but you didn't have to. And if you didn't, there was no financial consequence for you not doing that. Now there is, if you're an applicable large employer. So this was a piece of furniture that showed up 4 years after the law was signed, just about, and there was a surprise. It wasn't quite what we thought we had ordered. We were under the impression that an applicable large employer out of the gate was going to be any employer with 50 or more full-time equivalent employees. The surprise was that the federal government broke the large employer market into 2 different markets. They said, we're going to basically enforce this law starting January 1st of 2015 for any employers with 100 or more full-time equivalent employees. And we're going to give the employer group between 50 and 99 an additional year to comply with the law. So we're going to talk about employer reporting in just a second. The employer reporting requirement does not follow this same schedule. You still, if you're an employer with 50 or more full-time equivalent employees, you still have to do all of the ACA reporting starting now. But if you're in that 50 to 99 category, you don't have penalty exposure until 2016. They gave you an extra year. So that was a surprise. We didn't see that one coming. So just to talk about the penalties very quickly, again, we've got a pretty short window of time here. Usually our ACA workshops are a couple hours in and of themselves, so we're just going to breeze through a recap. Hopefully this is not new information to you about how these penalties work and what they are. But the first one is if you're an employer failing to provide minimum essential coverage. And minimum essential coverage is basically defined as any form of group health insurance plan. And actually there have been some products that have been created just to satisfy this minimum essential coverage or MEC requirement that's even skinnier than a group plan. But essentially what you're saying is if you're failing to provide any coverage to your employees, you're just simply not choosing to do that. Where before there was no financial consequence, Now there is. So if I'm an employer with 100 or more full-time equivalent employees, starting in 2015, starting in 2016 for 50 to 99, I'm facing a potential penalty of $2,000 annually on each of my full-time employees, and that's triggered, like I said before, if one of your full-time people goes to the public marketplace, applies for coverage there, and receives a subsidy based on their income and the fact that you're not providing them coverage. If they do that, and if there's a subsidy received by one of your full-time employees, that triggers a penalty on all of your full-time employees. So it only takes one person to ruin the party for everybody in this scenario or in this environment. And the government gives you the ability to subtract out a certain batch of full-time employees from that calculation, though. So it's not all your full-time people, it's all your full-time people minus the first. Does anybody remember that? 50? Close. 30? You're jumping ahead to 2016. So that was originally the law, was you got to subtract the first 30 out. But because they broke the two employer groups from 100 plus and then 50 to 99, the first year you can actually subtract 80. So if I'm a large employer, 100 or more full-time equivalent employees, that $2,000 penalty, if triggered, is assessed on all my full-time people minus the first 80. In 2016, that drops to 30. So that's correct. So a lot of employers, I think, initially, right out of the gate, stepped back and started doing some quick math, and financially, that probably looked like an attractive option relative to the premiums you were paying. But again, let's go back to pre-ACA. If you were offering benefits then without a financial consequence, we have to ask, why would you stop offering benefits now when there is a financial consequence? It's just sometimes strategically that argument doesn't always hold up. So, but nonetheless, it's a business decision that all of you are faced with, and one that you ultimately have to decide on. So there's another scenario here that we haven't talked about yet. So that was if you're not offering minimum essential coverage, essentially not offering benefits to your employees. Let's talk about if you are, but it's not conforming to the guidelines that the government requires. So the two tests that you need to be concerned with if you're providing benefits to your employees is it good enough and is it cheap enough? That's the simplest two ways to explain that. The good enough test is concerned with a calculation called minimum value, or MV. And essentially, we have not seen a plan fail the minimum value test. It's a measurement, and actually CMS, the Centers of Medicare and Medicaid Services, released a calculator that allowed you to figure out the minimum value or the actuarial value of the benefits that you offer. It's a calculation that factors in your deductible and your out-of-pocket costs and your co-pays and those types of things. Once you do the math around all of those plan components, as long as the actuarial value is greater than 60%, which we have not seen a plan fail that test yet, you're good to go with the good enough test. So that's what you need to be concerned with there. Once you're done with that test, you need to test affordability. So that's the cheap enough test. So affordability is defined as 9.5%, or technically 9.56% of the employee's wages for single coverage. So is the employee being charged more than 9.56% of their wages to cover themselves on that minimum value plan that you're offering? So if you're offering multiple plans, you're only concerned with the least expensive minimum value plan. If they are charged more for a better plan, that's okay, as long as you're offering them at least one minimum value plan at a rate not to exceed 9.56% of their wages for single coverage. If they choose to cover dependents and that exceeds that amount, you're still okay. We're just concerned with single coverage. The reason this is important, and we'll see this in just a second, is when we get to the employer reporting piece that we're going to talk about, you're actually reporting the cost of coverage, and you're using some codes that correspond to minimum value and affordability. So you'll just want to kind of have those concepts under your belt. So if you're failing either of these two tests, you're faced with a potential $3,000 penalty annually, which is higher. It's triggered the same way as the other one. It's only when somebody goes to the exchange and gets a subsidy, but it's only on each of those people that go and do that. So where before, when you weren't providing any coverage, you were triggered, that penalty was triggered on all of your full-time people minus a certain amount. Because you're providing coverage in this scenario, you're only being triggered, that penalty is only being triggered on those people that are actually going and getting those subsidies. And the only people that would be eligible for those subsidies are the people that, in some cases, most likely, if you're meeting the minimum value test, it would be the people that you're charging a rate more than 9.56% for single coverage. So that coverage would be unaffordable for, let's say you had 100 employees, maybe you had 5 or 6 of them that were being charged more than 9.56% for single coverage because of their compensation structure. If those 5 or 6 people went out to the marketplace because that coverage was unaffordable to them, they could qualify for subsidies, and if they did, that $3,000 penalty would only be assessed on those people that actually got those subsidies. And if they did, you don't have to worry about that being triggered on the rest of your employee population. Does that make sense? Okay, just a little bit of context just to gear us up. Again, hopefully this information has been out for some time. We've done lots of education around this, and actually this is one piece that hasn't changed all that much since the law initially came out. So hopefully not totally new information for anybody here. So Sarah, do you want to just maybe go through real quick the full-time employee
Sure, yeah.
explanation?
We talk a lot about full-time employees with respect to the ACA because those are the employees you need to be concerned about. They're the ones that can trigger penalties, and they are the ones that you have to satisfy the reporting obligations for. A full-time employee, and we've all kind of heard this if you've been paying attention at all to the ACA, is generally somebody who works on average 30 or more hours per week or 130 hours per month. But the threshold determination is identifying whether or not somebody is your employee. And it's a common law standard, so really your W-2 employees, those are the people who are in your pool of employees. Now, if you use leased employees, or you use a staffing arrangement, or you have other unique kinds of, if you're using independent contractors, you want to make sure that those people are true independent contractors. The common law standard that the IRS uses like a 20-factor test in determining whether or not somebody is your common law employee. So if you use any of those kind of non-traditional arrangements, you really need to take a hard look at those and evaluate whether or not those people are your common law employees. 30 hours a week or 130 hours a month. 130 hours a month is equivalent per the regulations. But when we're counting to 50 or 100, determining whether or not these penalty provisions apply to you and whether or not the reporting provisions apply to you, we also need to take into consideration our full-time equivalent employees. So basically what that means is any part-time employees count as a fraction of an employee. So you may have 10 full-time employees and 200 part-time employees, but when you determine the fractions that those part-time employees are, you may in fact be above that 50 or 100 threshold, depending. So, and hours, I don't know if I'm getting ahead, but we're not just talking about hours worked. Hours of service is really defined as hours worked plus any paid time off, and also any FMLA leave, jury duty leave, military leave. Miss any? I think that's it. So, if you are looking at just your payroll records, for example, in determining how many hours somebody has, you may be missing things like an unpaid FMLA leave or something like that. So I think did I miss anything there?
No, I think that was good. This is just an example to reiterate Sarah's point. So here's a company that has 35 full-time employees, and they've got 20 part-time people. So on the surface, if you were just counting full-time employees, you would think you're not an applicable large employer. But once you've converted all of those part-time folks to full-time equivalents, you can see based on the calculation, those 20 part-time people convert to 16 full-time equivalent employees, which you add to your 35 full-time. So that puts you right at 51 full-time equivalent employees. So in this example, this employer with 35 full-time people would be an applicable large employer under the law, would have all the reporting requirements this year to comply with, and then potential penalty exposure starting next year in 2016. Now, if they had penalties, let's say they weren't providing coverage like we just talked about, they were failing to provide minimum essential coverage, they'd still be able to subtract out 30 full-time people from their 35 full-time total, so they'd only have penalty exposure on 5 people, but they still have penalty exposure nonetheless. So just keep that in mind. Okay? Where things get a little tricky is with variable hour employees. Does anybody have a variable hour component to your work force where when you hire somebody, you don't know that they're necessarily going to work full-time for you, always 30 hours or less than 30 hours? Good. Be very happy that you don't.
Yeah, I guess I just want to also note that variable hour really would include any part-time or seasonal employees. If you don't offer coverage to your seasonal employees, you might want to, make sure they are not a full-time employee under the law. I know in manufacturing it tends to be all full-time people, but if you do employ any seasonal or temporary labor, things like that, you still need to kind of pay attention to these rules to make sure that you're not inadvertently running afoul of that and subjecting yourself to penalties.
Yeah, if you come across a situation where you have an employee that when you hire them, you don't know that they're always going to work full-time or always going to be part-time, in that case, by definition, that's a variable hour employee. There's some different measurement rules that allow you to track and measure that employee's hours over a longer period of time. We said before there was a 90-day rule before you'd have to offer benefits to a full-time person. Well, if you're a variable hour person, you've got a longer runway where you can measure hours, you can track hours, and determine if over that period of time that person averaged 30 hours a week or more, and if so, they need to be treated as full-time and those types of things. So this is a topic that we could easily spend 90 minutes on just by itself. It gets very complicated. So be just grateful that most of you don't have this situation in your business. All right, so I think we're getting here to...
One other thing I just wanted to mention. When we were talking about who's an applicable large employer and counting to 50 and 100, I just wanted to mention that you are using the prior calendar year to determine your count for the current year. So you're going to look back at, for 2015, you're looking at 2014, 12 calendar months in 2014, you determine your count for each month and then you average them. So there is some complexity. If you are thinking you're hovering around that threshold, you may want to dig into that a little further so you're accurately counting your people. But it is retroactive. You're looking back at the prior calendar year to determine your status for the current calendar year.
Thank you. Okay, this is the fun stuff. This is code section 6056. So that's what we want to talk about today. So this is the piece of the Internal Revenue Code that really was just finalized in February of this year. So another piece of furniture, showed up late to the party, but a pretty important one. So this is the section of the Internal Revenue Code that outlines and directs you on reporting requirements as an applicable large employer, 50 or more full-time equivalent employees, happening now. So you're reporting what you're doing. If you're an applicable large employer right now, 50 or more full-time equivalent employees, you are reporting the coverage that you're providing and the cost at which you're providing it to those full-time employees right now for calendar year 2015. And that report is going to be due by January of 2016. So it's an important piece to get on your radar if it's not there yet, because we're going to go through the report in just a second. And just a quick disclaimer here, you may notice that at about the third line down, so you must file a return with the IRS that reports the terms and conditions of the healthcare coverage provided to the employer's full-time employees for the calendar year. So that's 2015 calendar year, but I said 3 little letters in there, IRS. So this is a tax form. We've provided in your folder a copy of it, and there's a couple of them, but the one that we're going to talk about today is the 1095-C. So the 1095-C form is the important form that each full-time employee receives. I think just flick, it's on the left-hand side, I think 2 or 3 back, you'll see the... Yeah, and actually the actual form itself is in the folder. Full form. It looks just like this. Should be on the left-hand side.
This is, I like to say this is analogous to the W-2 in that you have to provide each employee with a W-2, and then you also have to remit those to the IRS with a transmittal, the W-3. This is very similar in that you're going to be providing each full-time employee with a 1095-C, and then you're transmitting all of those to the IRS with a 1094-C transmittal. It's like the cover letter that goes along with it. So we're focusing today on the 1095-C because that's kind of the guts of it. That's what you're actually providing to the employee.
Yeah, so this is the form. Hopefully everybody's got one in their packet. Does anybody not have it? We've got some extras up here in case you don't. Okay. I think the easiest way to explain this form and go through it is with an example. So we wanted just to go through there. There's also a form right behind it, or a couple pages that say 1095 code cheat sheet. It's a stapled form. So you'll want to use those two kind of side by side. So if you want to pull both those out, I think this will help highlight how this gets done. But to Sarah's point, this is very similar to a W-2. So all of your full-time people, in this case, who were eligible for benefits during 2015, they receive a 1095-C, and the deadline for doing that is the same as the W-2. It's by the end of January of 2016.
Even if they weren't eligible for benefits. If they were
True.
a full-time employee for any month during the calendar year, they need to get one of these statements.
Exactly. And an important point that we talked about earlier, and sometimes this gets lost when people hear delay. So even if you're an applicable large employer in that 50 to 99 category, even though the penalties have been delayed till 2016, the reporting requirement has not. So you still have to go through and do this reporting process, just like the groups that are 100 or more this year. So just keep that on your radar. So here's an example. We've got a sample employer, 200 employees, 200 full-time equivalent employees with 150 full-time. So this employer has quite a few part-time people as well, but we know they're an applicable large employer just based on their number of full-time people. Coverage offered satisfies both minimum essential coverage and minimum value. So we know we're good on that front. And the employee-only cost for the least expensive minimum value plan is $125 a month, or roughly $57 a pay period based on 26 pay periods. So kind of a good baseline, hopefully that may be in line with maybe what you see in your business. But in this case, for me to cover myself only as an employee of this business for single coverage on that least expensive minimum value plan, it would cost me $125 a month to do that out of my paycheck. In this case, the new hire eligibility period is the first day of the month following 30 days of employment, kind of a standard waiting period there for new hire. And all full-time people are eligible for benefits at this employer. So let's talk about Joe. So Joe is a new hire. He started February 18th of this year. So based on that first day of the month following 30 days of employment, he'd be eligible, he and his dependents, if he has any, would be eligible for benefits on April 1st. And under this example, we're assuming that when he becomes eligible, he does enroll in benefits. So, question is, if you're Joe's employer, what does his completed 1095-C look like? Very good question. So we're going to go through a quick example of how this looks. So if you're fully insured, you're only completing parts 1 and part 2 of the 1095-C. That's a first important distinction. There is a part 3, and that's just the bottom half of that form, and that's only for groups that are self-insured. So if you're not self-insured, don't worry about part 3.
And just as a side note, the reason you don't have to complete part 3 if you're fully insured is because your insurance carrier is going to be, they have a separate reporting requirement. They're going to be providing your employee with a different form that provides them with that information. But if you were self-funded and there is no insurer, then you are responsible for giving them the part 3 information. So your employees, bottom line, if you're fully insured, your employees are going to be getting a statement from you and a statement from the insurance company.
Exactly. So part 1 is pretty straightforward. You're putting each full-time employee's individual information in that first section of part 1. There's also a section for you to put the employer information. So a word of caution though, I don't know if this will show up on the screen, but box 10, you're putting a contact phone number in here. So depending on the number of full-time employees you have, just be wary of whoever's phone number is going in there. If that's the HR person, that's your phone number, you may want to put Adam's phone number in there. Because you may get quite a few phone calls when this document is sent out for the first time.
Don't worry, I've got Brad on speed dial.
Yeah.
And one other comment on this section, who's the employer? If you are part of an IRS-controlled group of related companies, and maybe it's the parent company that sponsors the health insurance, but there's other participating employers, the employer is the employee's actual employer, not the sponsor of the plan necessarily. In most cases, if it's a single employer plan, it's one and the same. But if you are in that situation, you need to be careful about naming the correct employer here.
Okay, so pretty easy so far, right? This is where the fun part starts. So part 2, if you've got an employee that's worked for you for the entire calendar year and nothing's changed, let's say you have a January 1st effective date with your plan, so nothing changes with employee contributions throughout the year, you might be able to use that all 12-month column just to keep it easy. But in this example, you may remember Joe hasn't worked for us for the full year. He started in February. He wasn't eligible until April. So in this case, we're using each individual month column, and there are codes that go in on lines 14 and 16. So that's why that code cheat sheet is in there for you. So what you'll see, if we're just looking at the first 3 months of the year, there's a couple different corresponding codes. I'll explain what those are. So 1H goes on line 14. And what the 1H code represents is that there was no offer of coverage made. So the reason in January, when you drop down to line 16, 2A tells the IRS why no offer of coverage was made. And code 2A says, well, Joe wasn't an employee at that time. So that's why no offer of coverage was made. It's pretty straightforward for January, right? February and March, no offer of coverage was made, and the reason is 2D. And 2D says, well, Joe was in his new hire waiting period. Okay, pretty straightforward, no offer of coverage made because he wasn't eligible yet as a full-time employee. As we move over to April, we're saying now an offer of coverage is made. So minimum value coverage offer made to Joe, and at least minimum essential coverage offer made to his dependents, if he has any. 2C indicates that Joe enrolled in coverage. That's the code that says Joe took coverage. And then in the middle, line 15 says not necessarily the cost of the coverage Joe elected, but only what that number, that 125, represents is the employee-only cost for single coverage for the lowest cost minimum value plan. So this isn't, if Joe enrolled his family in coverage in a more expensive plan, you're not going to report Joe's cost of coverage. You're just simply reporting the lowest cost minimum value plan for single coverage.
It's the least amount he could have paid.
The least amount he could have paid for just covering himself on that minimum value plan. So all of your employees should have that amount look the same on their 1095-C. But what may vary, again, depending on people's hiring, firing dates, if somebody's worked for you for a full 12 months, the way that these codes populate this form throughout the year may look different based on the full-time employees that you have.
Or if you, for example, had, one plan for in-state employees and another plan for, an HMO for in-state
Exactly,
employees
that's
and
true.
a PPO for out-of-state employees, then you might not have the same. And some employers have implemented tiered contribution strategies. They charge a different premium for different types of employees. So in that case, you could have different contributions there too. So you can see that how this could become very complex, and it could be even more complex if you have that they waive coverage at first and then enroll later in the year. Maybe they get married, they have a mid-year special enrollment event. They add coverage mid-year, maybe they're terminated during the year and rehired or things like that. I mean, you could envision a million scenarios where different employees will have very different looking 1095-Cs.
The good news is that there are plenty of solution providers out there to help administer this process for you. So we've invested heavily in our agency to be able to bring solutions to our clients to help with this. Encourage you to talk to your payroll vendor as well. A lot of this information that you need for this 1095-C resides in payroll. So there may be a 1095 reporting solution that your payroll provider already is working on or can extend to you as well. But talk to your broker, talk to us. We believe that we belong in the trenches with you to help get these reports generated correctly and sent out in a timely fashion. And like Sarah just said, there's an infinite number of possibilities almost based on your hiring activity and life-changing events throughout the year where this can become a very quick administrative nightmare for one of you if this is one of the hats that you wear in your business or somebody back at your office.
Yeah, and we've seen in just kind of doing some market research on our end, we've seen the cost for this type of service. I mean, it's been all across the map. So, when you're talking to your vendors and figuring out who's going to do this for you, you want to figure out how much it's going to cost and what exactly they're doing for you. Are you really having to do all the work and give them exactly the pieces of
Each
data that
code.
needs to be reported, each code that needs to be reported in each box, and they're simply taking that data and populating a PDF form? Obviously, that's a lower level of service than if they are determining those codes for you or helping you through that process, consulting with you and things like that. So it's from one vendor to another. It's not necessarily an apples to apples comparison, but there are vendors out there that are going to be making a significant amount of money doing this. So you want to make sure that if you know whatever you're paying, that you're getting what you're paying for.
Absolutely. Yes. Absolutely. And you know, over time, I think this process will become pretty much as accepted as sending a W-2. But because it's new, because there's a new workflow associated with capturing this data, populating these forms, sending them out, it's going to be a rough couple of years, I think, for employers to kind of get their arms around how to do this. But we'll get there. We're here to help. You know, please don't hesitate to reach out if you have questions. And like Sarah said, certainly vet out any solution provider that you're talking to, because we've seen a full spectrum of costs and service levels out there. So just to reiterate again, 1095Cs need to be in employees' hands by January 31st of 2016. So the coverage that you're providing right now, you've got basically 1 month at the end of the year to get these forms populated, generated, and sent out. The full transmittal, which includes the 1094 that Sarah mentioned earlier as the cover sheet to this, plus every 1095C that you send out, you package all that up, and that needs to go to the government a month later. So that's due by February 28th of the year, immediately following the calendar year coverage. February 28th happens to be a Sunday, I believe, in 2016. So the first time you'll actually have to do this, the deadline's February 29th, because fun fact, it's a leap year next year too. So not to make things too much more confusing. And then any entity that has 250 or more of these returns that they're filing is required to do this electronically, similar to your W-2s.
And in that case, the deadline is actually March 31st.
You got an extra
So
month
you
to
get an
do
extra
that.
month to file electronically.
But not the extra month for the 1095Cs. So keep that in mind. Okay, so quick recap here, just to reiterate some of the information we talked about. So if I'm an applicable large employer that sponsors a self-insured plan, I'm doing the 1094C, which is the cover page, and all 3 sections of the 1095C for each of my full-time employees. Not relevant to you. Most of you in this room are in that next column, which is an applicable large employer that sponsors an insured plan, fully insured plan. In this case, you're doing the 1094C, which is the cover page transmittal form, and then the 2 sections, Part 1 and Part 2 of the 1095C for each of your full-time employees. If you happen to be a non-applicable large employer, meaning you're less than 50 employees, but you're self-funded, it's rare, but we see a few of those. There's actually a 1094 and a 1095B form that you would be completing. And if you're fortunate enough to not be any of these groups and just be under 50, fully insured, all in, congratulations for now, you don't have to do anything. For now, maybe. We'll see. See what the future holds. So just a quick, one last topic we wanted just to touch on today, and then we'll pause for some questions at the end, is the Cadillac tax. Has everybody heard about this? I know sometimes we used to not talk about it because it doesn't kick in for a couple years, and I just feel like 3 years from now in the ACA years is like dog years. It's like so far out there, but it keeps coming up. So, and I think it's important to get on people's radar now as well. So I'm gonna ask Sarah just to talk about the Cadillac tax quickly.
Yeah, I think getting back to Brad's analogy about the house without furniture, this is one of the last rooms in the house that still really doesn't have furniture. We have the room, we have the walls and the floor and the ceiling, but we don't have the furniture. But basically what the Cadillac tax is, and you've probably heard about this has gotten quite a bit of attention and is a concern to a lot of employers. It is a tax, an excise tax on high-cost health coverage, and it kicks in 2018, and it is a 40% non-deductible excise tax on the cost in excess of a specified threshold.
To that right now.
A lot of people are I think, misconstruing this requirement. The tax is actually only assessed on the amount of the coverage in excess of the dollar threshold, but the statute imposes a threshold of, for self-only coverage, $10,200, and for family coverage, $27,500, or anything other than self-coverage, $27,500. However, there is an adjustment factor, so when it kicks in 2018, it will basically be adjusted for, to the extent medical inflation, or the cost of health coverage on average has outpaced kind of the consumer price index for medical. So there's an adjustment there, so we don't know exactly what the dollar amount will be. And then beyond, after 2018, there are also some other adjustments that can be made to the dollar amount. A couple of examples are if your population in terms of gender, if you're predominantly male or predominantly female, and that differs from the national average, then there's an adjustment for that. And if you provide retiree coverage, there's an adjustment to the dollar amount. If you are in a high-risk industry, that's kind of a narrow exception, but there's an adjustment for that. So the dollar amount is not static. It can be adjusted in a variety of circumstances. But basically, it is the tax is assessed on applicable group health coverage. And that would include your major medical, health FSA, including employee pre-tax contributions, HSA, any pre-tax employee contributions or employer contributions to an HSA, if you have a health reimbursement arrangement, and certain other types of coverage that we won't go into today, because we're kind of talking high level here, because again, we don't have a lot of information about what this looks like. So anyway, you aggregate the cost of all of those types of coverage that are subject to the tax, and to the extent the total is in excess of whatever the dollar threshold is, that's the amount that's subject to the tax. Now, the tax itself is assessed against the coverage provider. For a fully insured plan, that's the insurance carrier. For a self-insured plan, that would be the person that administers the plan. So self-insured plan would include like your health FSA or an HRA. So it's assessed against those coverage providers, but it's actually the employer's liability, their responsibility. The employer has to calculate the amount of the tax, allocate it among the different coverage providers, because you may have major medical that's under the threshold, but then you add some of those other types of coverage and you're above the threshold, then there's an allocation that has to be done so that a portion of that tax is allocated to each of the coverage providers. And then notify those coverage providers of the amount of the tax that they are responsible for remitting. The IRS has not issued any formal regulations or really any formal guidance on the Cadillac tax yet. So that's why we are still waiting on that furniture to kind of figure out exactly what we're looking at. We can talk conceptually, but when you dig down, you peel away the onion, there's a lot of unanswered questions. And it still is not clear exactly how this is going to work. But the IRS did provide us with an IRS notice in February, late February, that includes, it was just kind of designed to inform the kind of benefits community about what the IRS is thinking, some of the things they're thinking as they are developing these regulations. So it includes some proposals for future regulatory guidance, including some different proposed approaches for for defining applicable coverage, what types of coverage is included, what's excluded, determining the cost. The statute says the cost of applicable coverage will be determined in a manner similar to how we calculate our COBRA rates. The problem is the COBRA regulations, especially if you're in any kind of self-funded arrangement, they really are pretty vague and obscure themselves. So what does that mean? So they have some proposals for how they are thinking they may propose to define or determine the applicable cost of coverage, and how those statutory limits apply, the adjustments, how all that works. And it also invited public comments on their proposals and any other Cadillac tax issues. This is a hot topic, especially in the public sector, where historically benefits, as you probably all know, have been very rich and very high cost. And so there was the deadline for submitting comments was
It is Friday.
Or it is Friday, yeah. The 15th, what day
As
is
soon
it?
as you guys leave today, make
Yeah,
sure
so
you
go draft your
put
comments.
your comments in.
But there have been a lot of comments submitted by a lot of industry groups and lobby entities and things like that. So this is really a big deal, and the regulations will be very informative when we get them. But so now we're just kind of, we want it to be on your radar and something you're thinking about and paying attention to, but we don't have a lot of detail on it.
So just to leave you with a couple parting words of wisdom or thoughts to take back to the office with you. Obviously, one of the themes here is that there's a lot of information that needs to be tracked. So again, hopefully some of this is not new information for you, but at least it now is on your radar maybe more than it was before you walked in here. Just to think about the type of information that you're going to have to start gathering. So, I mean, I think evaluating your current record keeping tactics and determining, if maybe you need to pivot on making some changes or some upgrades to the systems that you have or relationships that you have. I would not want to be doing this in the fourth quarter. I think now is the right time to be asking those questions and going through that analysis and making those decisions. Don't just necessarily look internally and think that this is going to be an internal bandwidth issue. Like I said, there are a lot of partners and outside vendors that are standing by willing to help. Most of them are also willing to get paid to do that. So just look at that as part of the cost of doing business perhaps, but also treat this like any other aspect of your business. I mean, don't just take the first guy that comes to the door and offers to solve a problem for you. There are a lot of people out there that are eager to do that and have the resources to do that. So coordinate externally as well. Sarah mentioned the control group analysis. Not sure if that's relevant to anybody in the room if you're part of a control group of other businesses or other employers. But if you haven't decided, if that factors into whether or not you're an applicable large employer, or if so, how that affects your reporting. There's a lot deeper discussion there to be had, so feel free to talk offline.
One thing we didn't mention, we didn't talk about the 1094C, the cover letter, but one piece of that form is a section where you actually have to disclose all of the members of your control group. So you want to be able to identify who those members are, if nothing else. And then, as I mentioned before, on the 1095C, you need to identify who that employee's employer is, not necessarily who is sponsoring the plan.
And who they call with questions. So
right.
Consider some of the communication demands that you may be putting on your staff internally, especially if you have a high number of full-time people receiving this document. It's the first time anybody's gotten this, there's for sure going to be questions. So just kind of anticipate that before you...
Well, yeah, and consider if you want to do any kind of preemptive communication in advance to let them know it's coming and what it's for, so that
Absolutely.
they're not, I mean, they are going to need the statement when they file their tax return at the end of the year, but when they get it, they might not know what it is and have questions, and if you can head those off kind of in advance, you might save yourself some headaches.
Absolutely. This is a big one. We hear this all the time, and again, we kind of started the presentation with this. Highly encourage you not to wait for further delays. These rules are final. These forms are final. Could they change? Absolutely. But waiting till the fourth quarter to kind of develop a strategy because you're hoping this may go away, we don't think is probably the right strategy. So we'll leave that up to you, that decision. I threw this one in here just because this comes up quite a bit, especially if you're under the 50 mark or kind of on the cusp. A lot of discussion around just canceling the plan altogether and just reimbursing employees to go to the marketplace and get their own coverage. Be very careful with this. The IRS has come out with some pretty black and white guidance that says you as the employer can't do that. There are some ways to deal with it, but it really can't be, and there can't be any form of reimbursement for an individual health insurance policy by an employer to an employee. You can give everybody raises, completely unrelated to the fact that you're no longer offering benefits, but that's about as far as you can go. So just be very, very cautious if that's a strategy that you're looking to employ in your business. And then last but not least, this is a term that comes up quite a bit, although it's probably one of the more mysterious terms in our industry, and that's ERISA. All of you that offer benefits to your employees, whether you're 2 employees or 2,000, have ERISA compliance that you need to be concerned with. And ERISA has been around since the mid-'70s. So it's always funny to see how much interest we get in the ACA. And then when we start throwing ERISA out there, there's kind of blank stares. But when you talk about fines, penalties, some of the unfavorable consequences associated with compliance, a lot of that is on the ERISA side of the equation, not the ACA side. So
Yeah, and just speaking from experience, we have seen a significant increase in the number of Department of Labor audits. ERISA is enforced by the Department of Labor, and they are auditing, and they are not just auditing the 10,000 person companies. I had one client that has, I think, 20-some employees and maybe 12 on their health insurance plan audited by the Department of Labor, and they have a checklist. They want to see all of your documents, all of your notices, all of your filings. So, you know, I think that's a good way to put it. Get your house in order. If you need help with that and determining, you know, what do I need? What is the Department of Labor going to ask for if they come knocking on my door? Please let us know. We have a lot of resources, and we've helped employers through that process. But it's not pleasant. It can be very painful when the IRS or when the Department of Labor is there asking for all of this stuff and you don't have it. So to kind of be prepared for that unlikely event that they do come knocking is a good thing to do.
yeah, I think, and that's a really neat aspect. It's nice to have a colleague like Sarah standing next to me, because while I'm an insurance guy, when we get into certain aspects of the law, it's nice to have someone that's been through it, stood alongside a client and kind of gone through with the Department of Labor on the other side of the table, and been able to point out before they show up what you need, getting all of those pieces in order. Would encourage you to reach out to us, as well as our colleagues at Jackson Lewis that you'll hear from in just a moment. They're also very qualified to help you through some of these things. So I'll finish with a riddle. This is a question, and the slides may have given them away, so don't click forward if you do. Actually, no, I think I took it out. What is that? What do you see in that? Is anybody? It's like one of those little splatter pictures. Does anybody want to throw an idea out? See anything there?
Eagle, hawk.
A hawk? I've actually heard that quite a bit. An eagle, so a bird. Anything else?
Great Lakes.
Who said that? Britt. Have you seen this before? I'm impressed. Yes, exactly. So, what's the point?
To hear.
You're drowning in the Great Lakes. So the point I was going for, which that's probably an equally relevant one, right? So it's hard to know what you're looking at until you have the full picture. And that's kind of the perspective we've taken here. As we talked you through the last 45 minutes or so, you know, you see how lines can get very blurry, and you go from insurance in one tone to legal to tax, and you're kind of jumping around all these different domains all the time now. So we think it's pretty important to kind of take a step back, and for you to pull together your entire team of advisors. You can't just have an insurance meeting anymore. You kind of have to have a strategic planning meeting that includes your attorney, includes your accountant, because all of these parties now have to work together in concert to make sure that you are completely compliant. So we encourage you to step out, zoom out a little bit, change the perspective a little bit, make sure you've got the full picture so you know what you're looking at. And then second, make sure you've got the right team around you. And we've got some more colleagues today who are part of that team, so without any further ado, I will yield the floor to the next presenter.